Top 3 Best Performing Forex and Stocks Candlestick Patterns to Boost Your Profits. By the time you finish this video, you'll know how to identify these formations, what makes them so lucrative, as well as the price structures to stay away from. Candlesticks are part of the most common technical analysis indicators in trading. Learning to use candlesticks in your analysis will definitely take you to places because they form patterns that represent price and show all data points into single price bars. This makes them more informative than the traditional simple bars and able to provide useful insights into the changes in the market. As a result, the analysis would be richer, which could lead traders to make better predictions and get a better understanding of the strength in the upcoming trend. Since the discovery of the candlestick trading strategy by Japanese rice traders back in the day, experts have identified numerous new patterns that offer high probability in trading. Thus, you would come across various different patterns which come in various forms, sizes, and shapes. You will find that some patterns are better than others, and some of them don't work at all in today's market. To save your time and cost, you don't have to try every single pattern to decide which ones are applicable. So in this video, we have identified 3 major candlestick patterns to improve your trading performance by a mile. Let's take a look at how to recognize the patterns and build a strong trading strategy from them. Number 1. The pin bar reversal pattern. Let's begin with my favorite candlestick called a pin bar. Like most formations, these can form as either a bullish or bearish signal. So what exactly qualifies as a pin bar? Let's take a look. Pin bars are arguably the most effective ways to trade candlesticks because the pattern tends to create a high probability of price action. Generally, pin bars represent an event in the market that affects both sellers and buyers. A pin bar reversal usually consists of a long tail, which is also known as the shadow or the wick. How to trade with pin bars. When trading pin bars, there are a few different entry options for traders. The first, and perhaps most popular, is entering the pin bar trade at market. That simply means you enter the trade at the current market price. Note: the pin bar pattern must be closed out before entering the market based on it. Until the bar is closed as a pin bar pattern, it's not really a pin bar yet. Another entry option for a pin bar trading signal is entering on a 50% retrace of the pin bar. In other words, you would wait for price to retrace to about the halfway point of the entire pin bar's range from high to low, or its 50% level, where you would have already placed a limit entry order. A trader can also enter a pin bar signal by using an on-stop entry, placed just below the low or above the high of the pin bar. Trading pin bar signals in a trending market. Trading with the trend is arguably the best way to trade any market. A pin bar entry signal in a trending market can offer a very high probability entry and a good risk to reward scenario. In this example, we can see a bearish pin bar signal that formed in the context of a downtrending market. This type of pin bar shows rejection of higher prices or the long higher tail, so it's called a bearish pin bar, since the implication of the rejection reflected in the pin bar is that the bearish will resume pushing price lower. Trading pin bars against a trend from key chart levels. When trading a pin bar counter to or against a dominant trend, it's widely accepted that a trader should do so from a key chart level of support or resistance. The key level adds extra weight to the pin bar pattern, just as it does with counter trend inside bar patterns. Anytime you see a point in the market where price initiated a significant move either up or down, that is a key level to watch for pin bar reversals. Pin bar combo patterns. Pin bars can also be traded in combination with other price action patterns. In this chart, we can see an inside pin bar combo pattern. The pin bar and inside bar combo is the most powerful, and it's an ideal setup to trade on the daily chart, either from pullbacks to key levels or as breakout plays in trending markets on the 4-hour or daily charts. The pattern in this chart could be considered the opposite of the inside pin bar. It's an inside bar inside a pin bar signal. It's relatively common to see an inside bar form within the range of a pin bar pattern. Often, a large breakout move will follow an inside bar formed within a pin bar's range. For this reason, the pin bar plus inside bar combo setup is a very potent price action trading pattern. How to trade the inside pin bar combo pattern. Inside pin bars are exactly what their name suggests, pin bars that are also inside bars. These setups seem to work best in trending markets and on the daily chart time frames. In this example, we can see a strong uptrend was in place prior to the formation of the inside pin bar combo pattern. We can then see price broke out above the high of the mother bar, and this would have been the entry point into the trend. Traders can place a buy on stop entry just above the mother bar high on an inside pin bar combo setup like this one. Then as price breaks out in line with the trend, you are brought into the trade in line with the current market momentum pin bar and inside bar combo trading strategy. Double pin bar patterns. It is not uncommon to see back-to-back or double pin bar patterns from at key levels in the market. These patterns are traded just like a normal pin bar, except they provide a trader with a little more confirmation, since they reflect two consecutive rejections of a level. Pin bar trading tips. First, as a beginning trader, it's easiest to learn how to trade pin bars in line with the dominant daily chart trend or in line with the trend. Counter-trend pin bars are a bit trickier and take more time and experience to become proficient at. Second, pin bars basically show a reversal in the market, so they are a very good tool for predicting the near-term, and sometimes long-term, direction of price. They often mark major tops or bottoms, or turning points, in a market. Third, not every pin bar is going to be one worth trading. The best ones occur in strong trends after a retrace to support or resistance within the trend, or from a key chart level of support or resistance. Fourth, as a beginner, keep your eyes peeled for daily chart time frame pin bars, as well as 4-hour chart time frame pin bars, as they seem to be the most accurate and profitable. Fifth, longer tails on a pin bar indicate a more significant reversal and rejection of price. Sixth, pin bars will show up in any market. Be sure you practice identifying and trading them on a demo account before trading them with real money. Practice makes perfect. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Number 2. The inside bar continuation pattern. The inside bar is one of the more misinterpreted candlestick patterns, simply because they aren't hard to find. This observation is especially true for those trading anything less than the daily charts. How to identify an inside bar on charts. The following steps are used when identifying the inside bar pattern on your trading charts. First, identify a preceding trend using price action or technical indicators. Second, locate inside bar pattern whereby the inside bar is engulfed fully by the preceding candle high and low. To recap, here's an illustration showing the attributes of an inside bar. The inside bar's range, high to low, should be engulfed entirely by the previous bar's range, also called the mother bar. Another way of saying it is that the mother bar should completely engulf the range of the inside bar. So what makes the inside bar so lucrative? When it comes to Forex or stocks candlestick patterns, the inside bar is my second favorite pattern to trade. Here's why. First, it can act as a profitable continuation pattern if it occurs during a strong trend. Second, it provides a favorable place to hide a stop loss. Third, a tradable inside bar doesn't occur often, but when it does it can be a highly effective candlestick pattern. Here is an excellent example of the inside bar in action. Notice how the inside bar in this chart formed during a strong uptrend. An established trend is a requirement for trading this particular candlestick pattern. The reason for this is that the inside bar is nothing more than consolidation. So we have a strong trend followed by consolidation, which leads to a breakout in the prevailing direction. Pretty simple stuff, right? Stop levels can be taken from the previous swing high or low, dependent on trend, as dictated by key price action levels. Using the stop as a benchmark, traders can use this stop distance to expand by a factor of 2 to realize the take profit or limit level. This creates a 1-to risk-reward ratio in line with responsible risk management. Fibonacci extensions may also be utilized as a limit forecast. Number 3. The engulfing bar reversal pattern. Similar to pin bars, bullish and bearish engulfing patterns also signal a reversal of the previous trend. Such patterns are also commonly called the bullish outside bars and bearish outside bars. Bullish engulfing patterns are characterized by a bearish candle, followed by a bullish one that engulfs the smaller bearish candle. It basically means that the buyers have overtaken the sellers and that they have managed to move the price up. Usually, such patterns can be found at the end of a downtrend. In contrast, if the closing price is lower than the opening price and it happens at the end of an uptrend, then it is a bearish engulfing pattern. Based on this chart, we can see that there is a large bearish candlestick that has engulfed the previous smaller bullish candlestick. In this case, it would be wise to place a sell stop order a few pips around the low of the pattern and target the next pivot zone. This would most likely be a win with a decent risk to reward ratio. While it's best to search for engulfing patterns at the top or bottom of a trend because it indicates an upcoming reversal, you can also use these patterns to trade in a more range-bound market. It's quite common to find engulfing patterns breaking above or below a range, which is helpful to make some nice breakout trades. Here are other examples of engulfing reversal trading to fully understand this wonderful strategy and to make the most out of it. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.